Another big day for the AI trade, a comeback one as NVIDIA is now up 6%. Joining us, Jay Hatfield, going to continue the AI chat and work it into his own expectations for further S&P gains on the year. Chief Investment Officer, Infrastructure Capital Management. Jay, so let's talk some Amazon first. I see that it's one of your favorite ways to play the AI trade, or at least that it might be a better one than NVIDIA at this juncture. Tell me why.
Well, we do think it's underappreciated, not really because of the AI component.
Okay.
Obviously, cloud service has a lot of momentum, but really because of the transition to professional management, they're focused on profitability on the retail side, and they're also advertising, particularly on Prime. So we see that gigantic business becoming significantly more profitable, and it trades at a more reasonable multiple. It has similar growth prospects to NVIDIA, but trades at a more reasonable multiple, and it's less of a momentum stock. So, of course, NVIDIA, we have a 145 target, so it's obviously less attractive at 140 than at 120. But Amazon is more stable right now, less of a momentum play, and we think has the fundamental value.
One thing I've thought about over the last year and a half, 2 years or so is the way the market seems to trade Amazon a little bit more kind of tied to some of its consumer focus and almost a certain degree of cyclicality that, even just the chart kind of trades like a Walmart in a way, which, I mean, maybe it should. How much of that factors into it, the strength of the consumer and the overall volume? I mean, the margins don't come from the retail side, of course, but in terms of their linkage to the economy, how important is that?
Well, we don't think that's that critical. I mean, it is oftentimes it's more, cost effective to shop on Amazon, but it depends. But we're really focused on the move to profitability. Their delivery system is much more efficient now. It's also faster, so they have a competitive advantage. So it's really not about surging sales, but more profitable sales.
Got it. Okay. So the productivity of the efficiency of delivery, I mean, that conversation, productivity, efficiency, kind of bends towards AI a little bit. I've been kind of surprised at how far they've fallen behind on the voice stuff. I mean, my Amazon Echo is basically worthless. They can wake me up in the morning. So it feels like they got to get something there. Do they not, Jay?
Well, I think so, but it could be more on targeting advertising than it is just selling Echo products. So, and Prime is a great example where, they were losing a lot of money, but now they're starting advertising. So it's a little bit like a Disney story where that was just buried in everything, but it's a big drag. So we think there's less appreciation of the cost side and, too much focus just on the AI high flyers.
Okay. So generally your view for stocks is quite bullish right now. You've pushed your own expectations in-house to S&P 6,000. Tell me where that's coming from and how much the secular growth trend of AI is a role in that versus your macro view. I know you think that we are going to be forced to cut. It doesn't sound like you've got the most positive economic outlook, but one that is buffeted by eventual cuts, multiple this year.
Yeah, so the reason we upgraded the target was really twofold. I mean, it's been based on AI and lower rates the whole year, but you saw the AI trade broaden out, most importantly with Apple. And we think people are too negative about AI in that it's not just AI, it's also faster parallel processors, GPUs. There's a lot of applications for that. And it's going to most likely engender an upgrade cycle, which is going to benefit most tech companies, including Apple. And even so, the rally is significantly, even though we're all obsessed with NVIDIA, significantly broadened out. So when Apple's rallying, it's sort of hard for the market to go down. So that's part of it. But we also think the economy's softening, not crashing. And that'll become more obvious when we get the employment report at the end of the month. And then also we're headed into earnings season, and we think that most U.S. companies are doing really well. So that'll be a positive catalyst. June is usually not a good month for stocks, but yet we're at all-time highs. So that's, we think, is very bullish. It means that 6,000 is a more appropriate target than 5,750.
So next employment report, it seems like you think is going to come in soft. what matters more, the employment reports or the inflation prints? We'll get a fresh PCE later this week. Jay, do you think the inflation numbers are going to continue to soften? Think we're going to get repeats of the last batch we got that looked pretty good?
Yes, and so we're very likely to roll down to 2.6. And, that's our forecast, but it's not really a forecast. It's just a mechanical translation of PPI and CPI into the PCE weights. So the whole street is pretty clustered around our 1.1 number, or 0.11 number rather. And that implies a roll down to 2.6, which should be sufficient for the Fed to cut. We have a Fed that's chronically behind the curve, arguably one of the worst Feds since the Great Depression. So they're only going to do it when it's entirely obvious, which should be by September. But at least the rhetoric should soften up. And I thought it was encouraging that Mary Daly did highlight that the labor market is weakening. Continuing claims are rising. That's a leading indicator. The Fed prefers lagging indicators, but hopefully some of the more labor-focused economists like Mary Daly will get them to focus on claims.
Understood. Hey, Jay, real quick, last point is that if you want to play cuts, why not go the international route and skew towards non-U.S. companies, which have been doing pretty well this year and do have the tailwind of interest rate cuts more imminently and lower valuations?
Well, certainly if we're correct about the cuts and rates being lower, every asset class is going to do well. We just don't like the risk of the European economy. They have a very weak economy. The only real reason they're not in a recession is because of the U.S., but tourism and net exports are a big positive for them. So why take the risk of weak earnings and also some political risk? We have the French election, UK election. We don't have that. We have an election here, but at least we don't have a parliamentary system. So why not stick with capitalism instead of socialism?
Got it. All right. Well, what can I say to that? Can't disagree, Card-carrying American. Okay, all right. Capitalist. Thanks, Jay. Appreciate your time. Good to catch up, Mr. Hatfield.
Thanks, Oliver.
All right. Bullish on stocks. No question about it. Jay Hatfield, Chief Investment Officer, Infrastructure Capital Management.